Well, good morning. Recently, I've been asked this question. How can we make a little bit more in this low interest rate environment? How do you answer that question? Well, this morning I received this report. Let me show you. The US Treasury Yield rate for 10 years has been reduced by 1.94% in the last 1 year, and 30-year bond rate yield declined by 1.48%. Well, that's why a lot of the income-producing fixed bonds unit funds has been declared a lower yield right now, lower interest rate for the investment bonds. Well, if you look at the insurance company, right now, a lot of insurance companies has a lot of new products. Of course, new products have increased rates, have lowered their investment expectation. Right now, for example, in IA policies, the pessimistic and the forecast, most likely forecast and optimistic forecast spread around 2.7%, 3% to 4.2%. So that is realistic for AIA to predict that we can make a 3% yield compound growth rate, at least a low interest rate environment. But if you're a professional investor, you will notice that the government bond rate yield, when compared to the business bond yield, there's still a wide spread. That means if you can choose the right corporate bond, you can improve your yield by a little bit. And of course, as a professional investor, you can leverage your investment, make it 5 times, 10 times more, so you can enhance your overall yield. And your yield will be affected by the interest rate movement, by the credit risk you're facing, by the inflation rate, by the political issues, and also your reinvestment risk. And of course, as I said, if you're professional investors, you have a good financial planner, investment advisor, and have large enough your money, you can invest in corporate bonds and using your leverage to enhance your yields. But if you are like me, have no time, or you don't know enough about the bond market, you want to have to protect your capital, preserve your wealth, and at the same time, you want a little bit better a yield, better investment return for your retirement, for your children's education, 10 years, 20 years down the line, or you want to have a portfolio, you want just to diversify it into different maturity and different currency denomination, or you wanted to just protect your wealth so that you can give it to your second generation. If for these purposes, well, you should seriously consider the investment strategies offered by the insurance companies by buying a long-term savings product. The insurance company taking your money and putting in a pool much larger than any investment fund in the world, and then invest in corporate bonds. A diversified portfolio, a global approach to the bond market will have better yields and better risk to manage. And of course, some of them can choose to invest in some long-term equities, infrastructure, or stocks, where they can make an escalating return after 10, 15, 20 years. So if you want to protect your capital, at the same time want to make it better than inflation, better the bank deposit return safely without any worries, always get back your money with just a little bit more, then you should seriously consider the investment options, savings options. Present, it offers about around 3%, and that is realizable. And then the optimistic view of making 4.2% in a 20 years period. Well, if you want to consider that, talk to your financial planner or talk to me. I'm Dr. Augustine Chow. I've been in the financial business for 40 years. So if I can help, please give me a call. My telephone number is 9123-4196. 9123-4196. I'm Augustine Chow. I'm looking forward to serving you. Thank you for listening. Goodbye.